Good afternoon, everybody. Today is Wednesday, the 4th of August, 2010, and this is Brian Shannon from alphatrends.net speaking. Hope you can hear me loud and clear. Let's go ahead and take a look at these markets. I haven't been on here since a week and a half ago, but in that time we've had some pretty healthy action in the market. So the S&P 500, as we see, closed just below that 113 level, and the high right here from June is 113.20, and that's a level that a lot of people, myself included, have been watching since this bigger sell-off below the 104.5, 105 level. We've seen over the last several weeks a nice pattern of higher highs and higher lows, and that price action has dragged the 10-day moving average and 20-day moving average up through the 50-day moving average. That's the green line is the 50, so we've got the 10, 20, and 50-day. That purple one is the 20-day moving average of volume, which you can see the volume has been diminishing here, and that always gives us just a little bit of a reason to say, well, the buyers aren't really, maybe as strong as we would like. Maybe it's just an absence of supply in this market. But you can't deny the fact that prices are higher, and what price pays is only price, obviously. I'm a broken record player on that mantra, but I say it every time. If I said it as many times as I heard, yeah, but we were up on light volume, then I would be saying it nonstop pretty much, because I hear it all the time. Well, we were up, but on light volume. That's just a fact of the market. We can rally on lighter volume, and we've had some great rallies this year on diminishing volume, such as the March and April rally occurred on, the whole time the volume was diminishing. Look at the 20-day moving average was declining throughout that rally, and we're just looking at summertime trading actually. So again, focus on price action, but look at that volume as a reason to say, well, maybe we will be a little bit quicker to take our profits if this market starts reversing. But we're showing good positive action. We've closed 3 days in a row now above that 200-day moving average. That's a level that a lot of people are watching. And we're setting up, I think, if we can, clear this 113.20 level with and maintain it for without breaking this pattern on the shorter term time frame of higher highs and higher lows, then you look at this market and say, where does it have the potential to go next? And I would think that right near that 115 area would be the likely target, where it's where we had a little bit of support here intraday and then that resistance. So I think that we're headed, it appears, towards that 115 level. It doesn't mean that's a target and you just buy and hold until it gets there, or hope that it gets there, because we have to manage our stops on the shorter term time frames. And we are yesterday we had tested the first level that we were looking for support at, which was 111.80. Below that we were looking at the 111 area, as that's approximately where we were finding the 5-day moving average and where we had these tops and basically what would have closed that gap. So as long as we maintain above, really 111.80 still remains an important area. If we remain above 111.80 over the next couple days, we still give the benefit of the doubt to the buyers. We did clear the highs for the week here today. That is Monday's highs. And again, the only thing you can really complain about here is volume. But if you trade to make money, then the volume argument is really pretty foolish, because only price pays us, and that's what and it's moving higher. It's a nice pattern of higher highs and higher lows. So today's action was just a kind of a steady grind higher, but it was back and forth above and below that volume weighted average price a little bit. But it was obviously a constructive day, as we did gain 0.2% on the SPY, and we're at an important area where a lot of attention is coming into this market. So let's see if this market can maintain support. That's really what the job is in this trend, is we want to manage risk. We've got a rising 5-day moving average, and we break down below that 11.80 level. That's where we would have a little bit of reason for near-term concern, I guess. For those of you who are looking at it on shorter-term basis, then you want to look at these higher lows and say, well, if it breaks, maybe this would be an important level for tomorrow near about 112.40. But it looks like we're headed towards 113.20, and we've got a lot of we've got some pretty good participation in this market. The Nasdaq, that is, that we've had, today 2,200 advancing stocks and just 789 decliners. So the NASDAQ had cleared that 46 level we were talking about. We have a rising 10, 20, and 50-day moving average in there as well. We're about to see a golden cross here, which I would say pay zero attention to. Those are longer-term moving average things that occur, that aren't good timing. Since we had that bearish cross, the market has gone pretty much, not quite, but almost straight up. This level, though, here for the NASDAQ, up near about 4760, that's going to be kind of the, where we would expect this market to rally to on this leg. That, in other words, we would think that where's the potential for resistance in this market? That $47.60 level is where we would likely expect the market to at least slow down. Not necessarily that it would halt altogether there, but at least maybe slow down in that area. And looks like my server received terminate from server. I don't know if that's a Realtek issue or if that's this broadcast. But if it's this broadcast and it's an internet issue, then Comcast sucks. But we knew that already. Anyways, let's go back. Looks like we've got it back. So let's take a look at these cues. This is where we would expect the market to gravitate towards on this leg. We have the higher highs and higher lows on the 10-minute time frame here, for instance, where we look at prior levels of resistance are acting as support, and we've got this high. We broke the highs of Monday here today, had that sharp sell-off quickly, and then the market recovered very nicely as well. So we've got these higher lows, and right now looks like $46.70 will be a near-term level for tomorrow to just kind of keep an eye on, where we want to get a little defensive if it breaks below there. We've got this little trend line from Friday's lows as well, and I didn't notice that earlier on the SPY, so let's just take a look, and we don't have that here actually. But anyways, let's go back to, I actually bought some calls in the IWM today. My thinking in here is that you look at, for instance, this 30-minute chart, we can see that we've had some resistance right up here at about $66.60, and we have these little higher lows with a rising 5-day moving average. If you back this out, for instance, to the daily time frame, you can see we've got that 10 up through the 50, the 20's coming up through it as well, and it looks to me like the level that this IWM should test here, if this market's going to continue to get some strength. I think that this market should be able to run up towards $68 a share. So I was looking at the options, and I figured, when would I expect that this market could get to $68 a share? Does it seem likely that by the third Friday of this month, that is August 20th, that is 12 full trading days from today, does it seem realistic that it could run from 66.30 up to 68 if it gets going? Well, first thing we need to do is clear this resistance here. This is obviously the near-term level, $66.58 basically. Getting up above there, and the evidence is saying that we're showing these higher lows above a rising 5-day moving average. There's a lot of strength in the market. We've got good breadth, that is. So it seems likely that the Russell 2000 is going to continue to rally, and I think a price objective of $68 a share looks very reasonable. So I looked at the call options, and I saw that the August 25 calls are trading for 25 cents each. So I bought some of the calls at 25 cents. Now basically they're really worth nothing, except for time value. But if this market makes it up to $68 a share, then that the $25 per contract would be worth $100 per contract, and my risk is absolutely limited. So if this market, if I don't feel comfortable taking overnight exposure, and because I think that, hey, maybe we gap lower, maybe we gap down to $64 a share, that would certainly suck if you were long the IWM. But if you're long the call options, the worst you're going to do is risk $25 per contract. So based on the amount that I feel is appropriate to risk on that bet, it seems like a good probability and a good way to play it. Now, I know there's a lot of people who say, well, you should have done this more advanced strategy or whatever, but that's the way I like to do it. I'm a premium buyer. That's what's worked for me in the past. So I think that the Russell 2000, it looks like it's set to continue higher. if the market gaps down in here, or, trades down towards 65.5, I'd probably sell them at down at 15 cents or so, I bet, or maybe 17 cents. But I would still try to limit my losses. I wouldn't necessarily think that I'm going to give up the whole premium that I paid, unless, of course, we gap lower, and that's a different scenario. But that's that part of buying calls instead of having outright exposure to the index is that we can strictly limit our the amount that we risk. And if you're interested in more advanced strategies, follow guys like Adam Warner and Stephen Place and Larry McMillan. Those are the people who get that math and their brain works in the gamma and alpha and that sort of way. But to me, it's more of a kind of street smart type of option strategy. So it's a roll of dice a little bit, but you put into it what you're comfortable with in terms of what you perceive the risk, and it's not a way that's ever gonna crush you. The semiconductors have been stuck in the middle of the range here, the range being basically 25.5 to 29. We've been kind of stuck in here near this 50-day moving average, and the semiconductors just the last few sessions have given a little bit more reason for not necessarily concern, but just for caution, which is that they rallied up to that 5-day moving average, which is declining, and sold off. But this level in here, the 27, if we break the 27 level, it would really, I think, put this whole market on a little bit more defense. And even below just this low here, 27.25, would be reason to just kind of stand back a little bit. But right now, the semiconductors are pretty neutral. The financials, as we know, we've got this $15 level that everyone on the planet knows about, and we've closed at or below it here the last couple days. Let me draw that trend line, that horizontal trend line, and I didn't draw it right again, so let's do one more time. Anyways, something that looks like this. But as I've been pointing out, we've got what looks like a perfect shoulder, head, and then right shoulder here. So an inverted head and shoulders pattern. I don't mean to talk this pattern to death because, a lot of times the obvious patterns simply don't work. They end up being a trap. But you look at some of the other evidence, such as the 200-day moving average. We're closing right above that now 3 days in a row. And we haven't done that, basically since back in early May. And we have these, within this, forget about the inverted head and shoulders pattern for a moment. Just look at the resistance. Resistance broken tends to act as support. Where these higher lows coming into it. So as I had said in a chart on Chartly on Monday morning, I believe, it said that as long as we hold above that 1450 level, then you give the benefit of the doubt to the buyers, and the height of this pattern added to the breakout point at 15 would give us a price objective based on Technical Analysis 101, which doesn't always work, of $16 a share, $16.50 a share. The important thing, more than being able to recognize these patterns, though, is what's the psychology. We had this resistance. The buyers kept coming up to it and getting rejected and turned away. But then, and they got turned away pretty hard right here. So that was just regular resistance, but it's the 200-day moving average as well. And you could even go in and say, well, from the highs earlier this year to the lows this year, that's that was also, well, it wasn't a Fibonacci number. So forget that for a moment. But the point is that we had more repeated tests of that resistance, the time in between. We got more aggressive buyers time-wise and price-wise. It was able to drag those moving averages higher, and the price holds up in here. So the question here in the financials is, we don't have, officially, if you look at a textbook, we had a buy signal as it broke above that $15 level. Now, that's the science of technical analysis. However, there's a big difference between the science of technical analysis and the art of trading and making money. Anyone can recognize dojis and triangles and that sort of thing, but it takes experience and understanding of market structure to really understand why that's important. Well, it's important because right now what we have going on in here these last 3 days, we want to say, is this market, is this a failed breakout at that $15 level because it closed below it 2 days in a row? Or is that such a round, obvious number that we're still holding these prior resistance levels. This is more important, that we're holding this resistance from last week, or even down at 1480 would be a decent level to hold. Maybe get a little shakeout below there, then a lot of people would jump in on the bearish side, and then when and if the market recovered, then you would see what it amounted to a bearish, a failed bearish pattern, or a failed bearish breakdown of that. And so the question here is, the last 3 days, 2.5 days basically, is this distribution here, and this is going to be a failed breakout? Because if it's a failed breakout at $15 a share, then we're going to break this trend line as well, and maybe we're going to head back down towards 1460, and all hopes for a summer rally continuation are off. Or is this right here, this sideways action, is it just bringing in more short sellers? I didn't listen to her yesterday, but I saw I forgot her name. Oh, Meredith Whitney on, and she's usually talking bearish. I didn't listen to it, so I don't know if that's what she was saying. But the market does seem to shrug off bad news in general, and and not just the financials, but we have good, basically a favorable response to earnings. So the question is, are we just sucking short sellers in here who are going to get set up for a squeeze higher and add fuel to this breakout? So in other words, it's, as a breakout trader, I want to buy it and just see it run. Obviously, anyone does. As soon as you want to get in, you want to just see it run. But is this actually making it a little bit stronger by kind of stalling here a little bit and sucking in some short sellers and getting rid of the weaker holders that will just provide more fuel to the upside? So realistically, I think that 1480 is probably near term an important level for intermediate term traders. Longer term, 1450 would be trouble, I think, and would say, yeah, we're going more neutral like the semiconductors if it did that. So anyways, that's kind of a quick look at these markets and some of the important sectors. Let me just point out one other one, which is the oil service, OIH. The OIH broke, this is basically their $15 level. They broke that on Monday as well. We had these higher lows. We had all those moving averages cross back up. It's holding these gains pretty well. You look at this and say, hey, maybe the oil service group is headed for a test of this prior bigger breakdown level and maybe near that 200-day moving average. So there's a lot of, there's still the much bigger picture where we have to look at it and say, if we fail to break this higher high, or if we just marginally make a higher high in here then fail, is it still going to set us up for, are the bears going to reposition themselves for September and October, which everyone's afraid of during this time of year, because it's generally thought of as a negative time of year. And those are good things to be aware of, but it's definitely not something to trade on. Just like it's good to be aware of the lighter volume, but it's not something to trade on. You don't base short positions on light volume rallies, because a lot of times volume follows the price action. Anyways, let's just take a look at the Twitter here, and thank you, Derek, for that mention that it's always worth your time to tune in. Let's see, Banega, I guess. It wants me to take a look at Ford, and Ford has been performing real well. We had a shakeout in Ford on the weekly time frame that brought it down to its rising 40-week or 200-day moving average. That just served as something to that which didn't kill it made it stronger. We held well above these prior highs in here, so it came down to test that $10 level. On the daily time frame, we've had this rally. We've got all these moving averages rising. We're holding this 10-day moving average very nicely, and it's just been a nice stair-step pattern higher. It runs, it consolidates, it runs, it's consolidating right in here. And it's consolidating in a pretty tight range, which says there's still bidders in there, and perhaps it's heading up towards that 1450 level. It's in an uptrend on all time frames. So you look at this, and it looks like it had a shakeout midday yesterday. The stock's recovered from that. So I think that if you're long, you want to put your stop underneath one of these higher lows. I would say this 1280 area, because it survived an intraday shock whatever this was yesterday. Was it a fat finger? Was it news? Whatever it is, it recovered from nicely, and the people who sold on that shock movement, maybe they were getting short. Well, they're probably covering right now, or the longs who panicked. They're saying, well, what did we panic for? We got to get back involved in that. The longer term trend is still intact and getting back above about 13 and a quarter. Then it looks like similar to breaking this $12 level. So nice uptrend in Ford. Looks like it ought to continue. Just always know where your stop is. How about a look at Torchmark, TMRK, and Torchmark, or it's not Torchmark, I apologize. It's 470,000 shares a day, so it's liquid enough. Terramark Worldwide. Looks just like kind of like a slow stock. I mean, the range this year has been 6.5 to 9, which I guess is a decent range, but it's up at all-time highs here, it looks like. So that's a bullish thing. It broke out. It's pulled back. It doesn't look like a very exciting stock. It doesn't really do a whole lot. Short term, that is the last 3 days, we do have a pattern of lower highs and lower lows. So I would wait until we kind of stabilize, create a higher low, and then a higher high, like back in here before getting long. But benefit of the doubt goes to the buyers because of these longer term trends. And maybe it creeps up towards $10 a share, but it looks like it kind of creeps up, gets slammed, creeps up, gets slammed, creeps up, gets slammed. So it looks like a very difficult stock to trade because we have all these big red candles in here that I know it would have zero appeal to me, but maybe there's something good going on there, and if it matches your personality, then that's what matters more. Better Ready, could I take a look at BZF if I have the time? And I do, in fact, have the time. So the Brazilian ETF here. There's another one, which is, let me just see which one's more liquid. BZF trades an average of 129,000 shares a day, whereas EWZ, the Brazilian ETF, trades 1.5 million shares a day. So I would be more interested, if you're looking at a Brazilian ETF, I'd say you probably want to look at EWZ, but you're asking about BZF, so I won't force that upon you, just because of liquidity. Big volume today, but that's not the norm. It's up at these all-time highs, so it looks bullish, and it looks like it ought to continue to move higher. It's innocent until proven guilty. You look at a 10-minute time frame, it trades by appointment, it looks like. So I would say you want to look at EWZ just because there's better liquidity, but you can't argue with something that's up at all-time highs, and the path of least resistance continues to be higher. Last one we're going to take a look at is for Enrique, and that is HXM, and then we're going to wrap it up here. So HXM, let's take a look here. Desoladora Home, whatever the heck that is. I don't speak Spanish, so I'm not going to attempt it. But it trades 209,000 shares a day. You know what? I'm not going to look. I'm sorry. I can't look at these thinly traded stocks and take them seriously. Don't let me up. So I'm going to let you up. 30-minute. It's in an uptrend, but I mean the liquidity stinks in these things. I just I can't take a good look at it. I'm sorry, that was Enrique. And Don't Let Me Up wants me to take a look at BP. Looks good on a 30-minute time frame. I can't trade BP. I think that it's in an uptrend. It's just had this huge rally. We had news today and big volume reversal. To me, it's probably more of a news comes out at the turning point. BZF is the currency. I'm sorry. Better be ready. So, anyways, but the Brazilian currency is in a nice uptrend. So, it's bullish until proven otherwise. But anyways, Don't Let Me Up. It's one of these stocks that it's too newsy for me personally. Objectively looking at the chart. Let's take a look at, on the weekly time frame, what kind of bounce have we seen? Almost exactly a 38.2% retracement. We're, rallying from these levels where we'd expect to find resistance at this prior support. Okay, so we've run pretty far pretty quick. We've had a release of news. We do have a rising 10, 20, and 50-day moving average. We had a high volume reversal today. Still Still looking good though, as you pointed out, on the 30-minute time frame. So we have that trend line. We have these higher highs and higher lows. I'd say breaking below 39 bucks a share, it's probably going to turn more sideways and then maybe drift down and start to digest these gains a little bit. But it's in an uptrend. If it can maintain that 39 level, then you have to look at it objectively and say higher highs and higher lows. That's also where we see that 5-day moving average. But breaking that 39 level, we will have broken this resistance, which has been support, and then I would say you'd want to move to the sidelines on it. So that's going to be a wrap, everybody. Thank you for tuning in. We will do it again on Friday. So until then, trade well.